Today is Thursday, 15th of May 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. In today's market landscape, investors witnessed a day of mixed momentum, characterized by robust performances in the technology sector that uplifted major indices, juxtaposed with cautious sentiment driven by ongoing geopolitical uncertainties. The tech sector continues to be the frontrunner, buoyed by strong earnings reports and renewed investor confidence in the sector's growth potential. This optimism helped offset some of the broader market anxieties, which were exacerbated by unpredictable international dynamics. Meanwhile, the Dow Jones Industrial Average and the S&P 500 experienced modest upticks, largely attributable to tech-heavy components. Companies within the tech industry are not only showing resilience, but are also pushing the boundaries of innovation, which is crucial in an era where digital transformation remains a priority across industries. This sector-specific optimism was a critical counterbalance to the more tempered movements seen in other sectors, which remain sensitive to the geopolitical environment. On the commodities front, prices fluctuated as market participants reacted to external geopolitical cues, reflecting a cautious approach. Energy prices, particularly crude oil, exhibited volatility, responding to the latest developments in global trade negotiations and regional tensions. These factors continue to inject a degree of uncertainty into the market, influencing commodity traders' strategies. Currency markets similarly mirrored these broader themes, with significant movements in Forex being driven by a mix of economic data releases and geopolitical concerns. The dollar showed fluctuations against major currencies as traders weighed the implications of global trade policies and interest rate forecasts. Overall, while the tech sector offered a beacon of positivity, the overarching theme of today's market was one of vigilance and prudence. Investors are keeping a close eye on geopolitical developments, recognizing the potential ripple effects on economic stability and market trajectories. The landscape of major indices reflects a mixed performance, highlighting varied market sentiments and economic outlooks. The S&P 500 index saw a modest gain, inching up by 0.10%, suggesting a cautious optimism or selective buying within the market. In contrast, the Nasdaq Composite showed a more significant uplift, climbing 0.72%. This increase could indicate robust performance in the technology sector, often a key driver for the Nasdaq, as investors continue to favor tech stocks amidst evolving digital trends. On the downside, the Dow Jones Industrial Average experienced a slight decline of 0.21%. This dip may reflect investor caution or profit-taking, particularly in traditional industrial and blue-chip stocks that comprise the index. The Russell 2000, which tracks smaller cap companies, fell by 0.88%, suggesting that smaller firms might be facing challenges, possibly due to rising interest rates or economic uncertainties that disproportionately affect less capitalized companies. The CBOE Volatility Index, often referred to as the fear gauge, rose by 2.95%. This increase in volatility suggests heightened uncertainty or risk aversion among investors, potentially driven by macroeconomic factors or geopolitical tensions. Across the Atlantic, the FTSE 100 in the UK and Germany's DAX both posted declines of 0.27% and 0.24% respectively. These drops could be attributed to concerns over economic growth or currency fluctuations impacting European markets. In Asia, Japan's Nikkei 225 fell by 0.98%, while Hong Kong's Hang Seng Index and Shanghai's SSE Composite Index also experienced declines of 0.79% and 0.68% respectively. These movements may reflect regional economic challenges, including export pressures and fluctuating demand dynamics. Overall, the mixed performance of these indices underscores a complex market environment, where investors are navigating a landscape marked by both opportunities and challenges, adapting to sector-specific trends and broader economic signals. In the bond market, movements in yields offer crucial insights into investor sentiment and expectations for future economic conditions. The current landscape showcases varied shifts across different maturities, reflecting nuanced market dynamics. Starting with the 10-year note, commonly regarded as a bellwether for the broader economic outlook, its yield has recently climbed to 4.528%, marking a significant increase of 0.6446%. This upward movement suggests a market adjusting to expectations of sustained inflationary pressures or a robust economic environment that might prompt central banks to maintain or even increase interest rates. Such a yield rise typically indicates that investors are demanding higher returns for holding longer-term securities, possibly due to concerns over inflation eroding future purchasing power. In contrast, the 13-week Treasury bill, with a stable yield at 4.285%, shows no change. This stability in short-term yields might reflect the market's confidence in near-term monetary policy predictions or a balanced view of immediate economic risks. It suggests that while the short-term outlook remains steady, the market anticipates more pronounced changes in the longer run. The 30-year bond yield has also risen, reaching 4.967% with an increase of 0.4855%. This ascent underscores a market expectation of stronger economic growth or persistent inflation over a longer horizon. Long-term yields are particularly sensitive to changes in inflation expectations since they affect the bond's real return over its extensive duration. The increase in the 30-year yield could also indicate shifting investor preferences towards equities or other riskier assets, as the opportunity cost of holding long-dated government securities rises. Overall, the varied yield movements across different maturities highlight an evolving economic landscape, with investors recalibrating their strategies based on both current data and future forecasts. The divergence between short-term and long-term yields can provide a wealth of information for market participants seeking to understand potential shifts in monetary policy or broader economic conditions. In recent trading, the currency markets have exhibited a mixed performance, reflecting a complex interplay of economic factors influencing global exchange rates. The US dollar index, a key measure of the greenback against a basket of major currencies, experienced a slight decline of 0.30%, closing at 100.732. This movement suggests a modest weakening of the dollar, which can often be attributed to shifts in investor sentiment or changes in expectations regarding US economic policy. Meanwhile, the euro saw a marginal increase against the dollar, with the EUR-USD pair rising by 0.30% to 1.12295. This uptick could be reflective of improved economic outlooks within the Eurozone or a recalibration of interest rate expectations. The euro's appreciation might also be indicative of a broader rebalancing in currency portfolios, as investors assess the potential impacts of geopolitical developments and fiscal policies across Europe. In contrast, the Japanese yen weakened against the dollar, with the USD-JPY exchange rate climbing to 145.75, marking a decrease of 0.61% for the yen. This decline may be driven by diverging monetary policy directions between the US Federal Reserve and the Bank of Japan, where the latter continues to maintain a more accommodative stance. Consequently, the yen's depreciation underscores the ongoing challenges faced by Japan in stabilizing its currency amid global market fluctuations. The British pound also experienced a modest gain against the US dollar, rising by 0.15% to settle at 1.32862. This increase could reflect a combination of factors, including positive economic data from the UK, or adjustments in market perceptions regarding the Bank of England's policy trajectory. The pound's appreciation is consistent with a broader narrative of resilience, as the UK navigates post-Brexit economic challenges while seeking to bolster trade relationships and domestic growth. Overall, the currency market's recent movements point to a dynamic environment where investor strategies are continually reshaped by evolving economic indicators and global events. The commodities market experienced noticeable declines across various sectors, reflecting a broader trend of downward pressure. Gold, traditionally a haven in times of economic uncertainty, saw a modest dip of approximately 0.85%, indicating a potential shift in investor sentiment or profit taking from recent highs. This decline in gold prices could suggest that investors are reallocating capital towards other asset classes or responding to macroeconomic data that reduces the immediate need for safe haven investments. Silver followed a similar trajectory, dropping by 1.28%. The decline in silver may be attributed to its dual role as both a precious and industrial metal, which exposes it to broader economic influences and shifts in industrial demand. The reduction in silver prices could be signaling a tempering of manufacturing forecasts or adjustments in investor strategies. Crude oil markets were significantly impacted, with both West Texas Intermediate and Brent crude experiencing declines of over 3.5% and 3.3%, respectively. This sharp decrease suggests concerns about global demand, possibly exacerbated by economic slowdowns or geopolitical developments affecting supply routes. These factors may have led to a reevaluation of future demand expectations, thereby influencing current pricing levels. Natural gas prices showed a relatively smaller decline of 0.63%. While natural gas markets are often subject to seasonal influences and weather-driven demand, this moderate decrease might reflect stable supply conditions or evolving energy market dynamics, such as shifts towards renewable energy sources. Copper, another industrial staple, saw a notable decrease of 1.44%. The drop in copper prices could be indicative of reduced industrial activity or revised growth projections in key global markets, as copper is heavily dependent on construction and manufacturing sectors. Overall, the observed trends in the commodities market highlight a period of adjustment, with investors recalibrating their positions in response to both immediate market signals and broader economic narratives. Exchange-traded funds, ETFs, continue to be a focal point for investors seeking diversified exposure across various market sectors. The recent market movements highlight the divergent performances across different segments. Notably, technology-focused ETFs have shown resilience and growth, as evidenced by a substantial increase of 0.65% in the technology sector, reflecting strong investor confidence in the sector's future prospects. This aligns with broader market trends where technology continues to drive innovation and capture investor interest. In contrast, the healthcare sector has faced significant headwinds, with a notable decline of 2.35%. This dip may be attributable to regulatory challenges and uncertainties in the healthcare landscape, impacting investor sentiment. Similarly, the financial sector, represented here with a modest decrease of 0.27%, reflects ongoing concerns about interest rate fluctuations and regulatory pressures that could affect profitability in the near term. Energy ETFs experienced a slight drop of 0.61%, possibly influenced by volatile oil prices and geopolitical factors affecting global supply chains. Meanwhile, the consumer discretionary sector, although not explicitly detailed here, remains an area of interest due to its sensitivity to economic cycles and consumer spending patterns. The performance of the small cap index, with a decline of 0.89%, underscores the challenges faced by smaller companies in navigating the current economic environment, potentially due to tighter credit conditions and market volatility. In contrast, the innovation-driven ETF, despite being a niche fund, posted a modest gain of 0.26%, indicating selective investor enthusiasm for disruptive technologies and growth-oriented companies. Overall, the ETF landscape reflects a mixed bag of performances across different sectors. Investors are closely monitoring macroeconomic indicators, geopolitical events, and sector-specific developments. Diversification through ETFs remains a strategic approach for managing risk and capitalizing on sector-specific growth opportunities. As market conditions evolve, investors are likely to adjust their allocations, seeking to balance risk with the potential for returns in a dynamic economic landscape. The stock market showcased a mixed bag of performances, with technology and financial sectors experiencing notable gains, while healthcare and energy sectors faced downward pressure. Among the tech giants, Nvidia emerged as a standout performer, surging by 4.16%, reflecting strong investor confidence in its growth prospects, possibly driven by advancements in AI and semiconductor sectors. Microsoft also posted a solid gain of 0.85%, continuing its upward trajectory as a leader in cloud computing and enterprise solutions. However, Apple faced a slight decline of 0.28%, suggesting a period of consolidation after recent rallies. In contrast, Intel suffered a significant drop of 4.61%, potentially due to ongoing challenges in market share competition and supply chain disruptions. Similarly, Tesla remained robust with a gain of 4.07%, buoyed by optimism surrounding its electric vehicle expansions and technological innovations. The financial sector saw positive movements, with JP Morgan Chase and Goldman Sachs leading the pack, up 1.0% and 1.29% respectively. This upturn may be attributed to favorable economic indicators and strong earnings reports that underscore the sector's resilience. Bank of America also recorded a healthy increase of 1.04%, further supporting the sector's overall positive sentiment. Conversely, the healthcare sector experienced pressure, with significant declines from Johnson & Johnson and Pfizer, down 1.40% and 3.72% respectively. Merck also saw a notable decrease of 4.12%, which could be linked to competitive pressures or regulatory challenges impacting the pharmaceutical industry. Energy stocks were mixed, with ExxonMobil and Chevron declining by 0.90% and 0.48%, respectively, amid fluctuating oil prices and market uncertainties. This sector's performance reflects the broader volatility in global energy markets. In consumer goods, Procter & Gamble and Coca-Cola showed marginal changes, with P&G slightly down by 0.45% and Coca-Cola inching up by 0.29%, indicating stability within the consumer staples segment despite broader market fluctuations. Overall, the stock market's varied performances highlight sector-specific dynamics and external economic influences shaping investor sentiment. In the realm of technology and artificial intelligence, the landscape is showing a dynamic shift, reflective of investor sentiment and market conditions. Notably, semiconductor giants are making significant headway. Nvidia and AMD have both posted impressive gains, with Nvidia climbing over 4% and AMD leading with an increase nearing 4.7%. This surge highlights the robust demand for their chip technologies, crucial for powering AI applications and data centers. Tesla also experienced a notable uptick, exceeding 4%, underscoring the market's continued confidence in its innovative edge in electric vehicles and autonomous driving technologies. Meanwhile, Alphabet, the parent company of Google, saw a healthy increase of 3.66%, likely benefiting from its ongoing advancements in AI-driven search and advertising solutions, which continue to attract investor interest. Conversely, some tech stalwarts are experiencing challenges. Apple and Amazon both saw slight declines, with Apple dipping marginally and Amazon by over 0.5%. These movements might reflect broader market uncertainties or profit-taking following recent highs. Intel, however, faced a significant drop of over 4.6%, possibly due to competitive pressures in the semiconductor industry, which continues to heat up with rivals aggressively advancing their technologies. Microsoft and Meta showed modest gains, suggesting steady confidence in their strategic ventures into cloud computing and social media, respectively. Companies like Salesforce, Snowflake, and Palantir, all seeing slight increases, indicate sustained interest in enterprise solutions and data analytics, which play pivotal roles in corporate digital transformations. Interestingly, Uber and Airbnb both experienced declines, with Uber dropping over 1.4%. This may point to macroeconomic factors affecting consumer-driven tech services. Lastly, the AI-specific company C3.ai saw a minor decline, reflecting the volatile nature of this emerging sector. Overall, while the tech sector presents a mixed picture, The underlying trend suggests strong investor interest in companies pushing the envelope in AI and semiconductor technologies, even as traditional tech giants navigate market headwinds.